Perfect. Good morning. Welcome to this short session on the remaining portion of alternative investments. So we are left over with a couple of things in alternative, which is infrastructure and digital assets. Quickly, please confirm you're able to see the PowerPoint presentation starting from infrastructure as a topic. And I think we shall begin in a couple of minutes, just waiting or expecting others to join in that short time frame. So we'll start in a couple of minutes. Just to confirm you're able to see the presentation. Okay, perfect. I think we are good to start then. We will pick it up from infrastructure where we have left it yesterday, and then move towards the last topic on alternative investment. Should be a relatively shorter session given the topics are fairly limited on alternative. Uh, so we will try and stick to the timeline as such. Now, when we talk about infrastructure, you can classify it under a subcategory. Let's say you can say this is a subcategory for real estate specifically, or if you want, you can read infrastructure separately under alternative assets. It is one asset class which is which is available for investment, and there is a reasonably good amount of interest when you talk about infrastructure investments, specifically in an emerging economy like India. Infrastructure by default, I think a lot of us understand, will have projects both from an economic perspective and both and also from a societal perspective, right? So the largest player or the largest participant in the infrastructure sector will be the government. These are capital intensive and long lived assets which are constructed by the government, obviously for either economic development purposes or for societal purposes, for example, to provide social infrastructure like schools, healthcare facilities, and sanitation facilities. So any type of infrastructure investment would typically lead to either social benefits economic benefits. You could have development from the perspective of slums, etc. These assets are for public use and cater to the essential services. A lot of us do understand infrastructure from that point of view. Most of these are financed and operated by the government. As I said, the largest player or the largest participant in the infrastructure market is the government, right? And they are the ones who are taking care of most of the assets. This is increasing, or there is an increasing use of public private partnerships. Now, this is not only in India. In India, we definitely see a lot of PPP projects where the government joins hands with private players and executes a lot of projects under the PPP route, which is the public private partnership route. But even outside India, this is a fairly common model. You look at Australia, you look at US, you look at any European economy for that matter. I think almost everyone has PPP model, which works smooth. Under a public-private partnership model, the public entity is the government, and the private entity will be a private player who is interested in participating in the infrastructure growth story. So the public-private partnership is the government or effectively goes into a joint venture or sets up a partnership with a private player, and the private player executes the project, constructs the project for the government to that extent. So in a lot of these projects, you're able to hear me, right? Am I audible to all of you? Because I don't see this icon showing a microphone working for me here. Am I audible to all of you? Okay, perfect. Thank you. Thank you so much. Yeah. So public-private partnership has been increasingly catching up, and especially in a geography like India. Reasons being, government can execute a lot of these projects on its own, but it takes time, and the government is stuck up with so many other things. Plus, from an efficiency perspective, the government believes the private players will be more efficient in constructing these projects, and parallelly, you can do a multiple projects and execute the projects. Different categories of it, and the best example of a PPP or the public-private partnership, mode working for India. If some of you would have read the Indian specific guidelines or things issued by the Niti Aayog. For example, in India, we have a national asset monetization pipeline, around which Niti Aayog has issued a couple of volumes of data. Best one, I think, is the next big thing under PPP in India from an Indian perspective is a lot of the railway stations, and to the tune of around 7,000 plus railway stations may go under a public-private partnership model. At present, all the railway stations in India are government owned, operated by the government, but the government is looking or exploring opportunities whether where railway stations could be allotted to private entities, and the private entities then take care of the maintenance, upkeep, development of the railway stations. Obviously, commercial aspects, right? So that is one thing that can change, I think, the entire infrastructure from a railway perspective. And you could have uh, railway stations akin to what airports are, right? Long back, when airports were controlled by Airport Authority of India, the commercialization aspects were not that great. Still, if you travel to certain airports, which are owned or operated by Airport Authority of India, you will see a stark difference between those airports and airports run by private entities in collaboration with government, right? So that's where public-private partnership may eventually lead to offer you better facilities. That all comes at a cost. Maybe the cost of you accessing the railway stations also increases, which is one thing that is debatable in the market at present. That it is such a common man mode of transport, that do you want to increase the fee from a railway perspective is something which is debatable. But PPP is here to stay, and PPP is evolving over a period of time. There are several models under a public-private partnership. There is a BOT, build, operate, transfer model. There is a TOT, toll, operate, transfer model. There is an HAM, hybrid annuity model. And these are all from, all of these models are actually evolving, lease and operate models. So infrastructure, when you talk about in any geography, you cannot stay away from PPP, public-private partnerships. Different categories of infrastructure investments. You want to lease the asset back to the government, right? So as I said, those BOTs and lease models and design, build, operate models. One is you construct an asset and you lease it back to the government. So the government takes it on lease and you get a regular source of income. Uh, Example, warehouses. Government focus on warehouse has been increasingly large over the last decade. The government needs warehouses to store food, grains, and other products. So the government gives a subsidy. Government says, okay, go ahead, build a warehouse, and as soon as you finish the warehouse, we are going to take it on lease from you. Specifically, when we say we, government entities such as food corporation, we take it up on lease. So you can construct an asset. A warehouse is an infrastructure asset, and you can lease it back to the government for a stable source of income. Then there could be investments to sell assets to the government as newly constructed. You can just construct and sell the asset back to the government, or third, you can hold and operate the asset on behalf of the government, which is the BOT model: build, operate, and transfer. You build the asset, you operate the asset for a certain period of time, and eventually, maybe after that time frame, you transfer the asset back to the government. So all possible models exist. It all depends on what the private player wants, what the government wants to offer. It's a uh, it's eventually down to the negotiation table, that whatever works for both the entities, and that's where the models would be closed. Infrastructure assets are capital intensive, as we said, right? You need a lot of capital to build any infrastructure asset, and therefore it creates a barrier to entry due to large scale of minimum investment required in these assets. Returns are also in the form of regular cash flows and some capital appreciation. But capital appreciation in general is a bit lower. You are not selling most of the infrastructure assets, right? The government keeps those infrastructure assets for perpetual basis. But yes, regular cash flows are something which drives a lot of people to infrastructure as an asset class. These are more or less sort of, annuity based cash flows. You don't have to do a lot of things. Once constructed, they keep paying you till you keep operating the asset. So this is sort of more of a regular cash flow story for a lot of players who participate in infrastructure as an asset class, or would like to invest in infrastructure as an asset class. Increasing intensity of infrastructure investment is seen around us due to increase in demand. The investors also want to invest, and increase in supply. The government also desires to privatize a lot of these assets. Now, whether that is good, bad, that is a debate for some other session perhaps. But companies or countries have started focusing on infrastructure assets, and this is not only for warehouses, not only for railway stations. Airports have been out there for a long time, but even for strategic assets like building oil reserves, right? So you need to have some storage for strategic reserves. You don't want to be heavily dependent on imports. So every country is now trying to build up strategic reserves, which means have some oil reserves uh, for emergency scenarios, right? Where the world goes at a war, there are no imports which are happening. Then in that case, for the next 3 to 6 months, can the country operate without importing any oil from cross borders? So focusing on gradually developing those strategic reserves, and that's again part of infrastructure investment. So the government also realizes the need of infrastructure, and you are seeing it build around you, whether it's the golden quadrilateral, which was around which was long back started, whether it is the now the Mumbai and Delhi corridor, which has been built up. You're seeing it across, and that is exactly what happens across a lot of geographies where infrastructure investments take place. They could broadly be classified into, as I said, economic assets and social assets. Economic assets are supporting economic activities, your standard roads and bridges and electricity, etc. While social assets may not have economic aspects associated to it, may not be economically viable or feasible, right? They may not be profit delivering assets, but they are directed towards human activities like education, healthcare. Uh, the government has to take care of these assets as well, right? They may not give them any benefits in terms of monetary value, but they do offer social benefits. Infrastructure investment can also be classified based on stage of development. So you typically call them either a brownfield project or a greenfield project. When we say brownfield or greenfield projects, we are looking at example. If you say a brownfield project, a brownfield is low risk project because you are enhancing the existing infrastructure, right? So if you have a plant and if you increase the capacity of the plant, increasing the capacity of the plant is a way to say that, okay, I'm doing a brownfield expansion. Brownfield expansion is straight away increasing the capacity of an existing plant. So a lot of cities already have an airport, like Mumbai. Mumbai has an airport, and Mumbai created a T2, a Terminal 2. That Terminal 2 is basically a brownfield expansion because you expanded the existing facility and you added a new terminal to it. A lot of people create plants for manufacturing purposes and they enhance capacity. Jamnagar, when first created, right? Reliance, when first created the Jamnagar refinery, it was a greenfield project. They had created it from scratch. From zero, they invested $1 billion at that moment of time, or and more than a billion actually, 7,500 crore. And that time the exchange rate was somewhere around 45-50. So you can say $1.5 billion. When the refinery was created, that was a greenfield project, absolutely new, uh, very high risk because you don't know how the refinery will operate. And after that, once created, they did an expansion also a few years ago of that same refinery. And that expansion was a brownfield expansion, right? Existing capacity of the refinery was increased. So you will read projects being classified as brownfield projects or greenfield projects. Whether they are new or existing getting enhanced will determine whether they're brown or green. And risk obviously for the newer projects are higher. For the older projects, the risk is lower because you already have some information around the older projects or the way how the older projects work. Risk and returns on infrastructure investments are dependent on category of assets, stage of development, geography, location, and form of investments, right? So it all depends on multiple factors. A lot of people want to take up airport assets because they believe airport assets offer better returns as compared to maybe taking other modes of transport. But again, remember that airport asset is also very, very dependent on what geography you want to take up for, right? So the highest bid goes therefore for Mumbai, Hyderabad, Delhi airports. And then automatically the bids are slightly lower for other cities where the airports have to be operated. Form of investment is also critical here. Are you investing equity or are you investing debt in these projects? Because the return will be heavily dependent or will be dependent on basically whether you are getting an equity investment or you're getting a debt investment. In terms of forms of investments, like we talked about real estate, and we said, you can do a direct investing, you can do an indirect investing into equity and into debt. We created 4 quadrants. Very similarly, in infrastructure also, you can look at a direct or an indirect investment. When we say infrastructure assets, which are direct investments, if you are making a direct investment, you get control on asset and you capture the asset's full value. Basically, you are the owner of the asset for that specific moment of time, which requires large investments, and liquidity risk is also high because once you invest in infrastructure as an asset, when will you be able to exit is a point to be considered, right? It's not easily a liquid, it's not too liquid, right? You cannot get up tomorrow and say, I want to sell the infrastructure asset that I have. You will have to wait for an appropriate buyer. You will have to wait someone who has deep pockets to buy that asset. So liquidity is low when you are investing into infrastructure as an asset. This is in line with what we talked about real estate, right? Real estate also has low liquidity. You will have to wait for the buyer and an appropriate buyer who offers you a fair price to go ahead and buy that asset. Investor has to manage and operate the asset, right? So in this time frame, till you are having a direct control of the asset, managing and operating asset becomes critical. when we say management of the asset is important, if the asset is not well managed, there is a possibility that we may lose a lot of value on the asset. So management, maintenance of the asset is critical in order to derive a value when you want to exit the asset. Indirect investments, where you do not want to own the asset and you want high liquidity, then you can invest into ETFs, listed funds, private equity funds. Like you can also invest into InvITs, like we have REITs, real estate investment trust. Similarly, we have InvITs, infrastructure investment trust. So you can invest in a lot of these asset classes which are very liquid, right? So for example, ETF, you can sell an ETF any day the stock market is open. You can redeem your ETFs. So very good liquidity. Fees is also reasonable, and investor is not required to manage and operate the asset. You can simply just uh, be a financial or a passive investor. Plus, if you're buying it through an ETF or a listed fund, your lower minimum investment is available, which gives flexibility to diversify into other asset classes. You can buy ETFs for as low as 500, 800,000 rupees, whatever their listed prices. So if you have a lakh, you can still invest 1 lakh or 10 lakh rupees in an infrastructure asset and get the benefits of infrastructure investing. This is in line with a lot of real estate investments also. So for example, let me just try and see if we can look at from a real estate infrastructure perspective. So please confirm me if you're able to see the website. PropShare website on your screens. No, you cannot see this. Okay, let me just try and see why is this not available on your end. How do I'm sharing the screen? Maybe this has an issue. So there are websites, for example, whenever you find time, try and look for websites such as PropShare, Meyer Capital. A lot of these websites allow you to make infrastructure investments or real estate investments, and that too at a very nominal or a lower cost, right? So you can basically be part of some of these investments and build your portfolio more from an infrastructure or a real estate perspective without owning the properties, right? Because owning the properties itself may be a bit problematic, or to start off with, a lot of people may not have the knowledge or understanding how to work on real estates, right? So websites such as PropShare or Property Share and websites such as Meyer Capital and many other websites will allow you to make these investments into real estate properties and infrastructure at a cost which is much lower than owning the properties, right? So you can invest actually into commercial properties also doing that. Okay. Returns from an infrastructure investment perspective, stable cash flows. Yes, once you invest into any of these properties, we have said you get stable cash flows in terms of rental or lease incomes. And apart from stable cash flows, you can also look at higher dividend payout ratios. Risk, few growth opportunities. These are very stable businesses. The cash flows are also very, very stable and fixed, almost sort of, rentals or leases or annual returns that you're getting are more or less pre-decided. So growth wise, there's nothing in terms of, growth. You have a very fairly stable fixed income stream if you want to just take an analogy. Leverage is very high. Yes, properties are financed using leverage. So leverage is on the higher end. There is operational risk in case of brownfield projects, and there is construction risk in case of greenfield projects. Brownfield means existing projects, and existing projects generally have risk in terms of operational parameters, right? The operations can come to a halt because of several reasons: labor strikes, shortage of raw material, disruptions due to any natural calamity. So you could have operational risk in brownfield projects where you're not able to operate the project itself. And then there is a possibility you have a construction risk in case of greenfield project, where the greenfield project doesn't even complete and your construction is halted in between, right? For whatever reason it may be a political reason, it may be an environmental reason, it could be anything. Infrastructure and real estate bring with it a lot of regulatory risk. Yes, regulations may change and that can bring the project to a halt. And that is something where we say environmental laws and rules and regulations are very critical. You have seen specifically on grounds of environmental clearances or environmental issues, projects have been halted or not allowed to be completed. And that puts the entire project and all stakeholders at risk. In case of global infrastructure investing, additionally, there is a currency and a political risk. Yes, a political risk, currency risk is obviously manageable, right? You can hedge currency. You can figure out a way to manage the currency related risk. But political risk is something which comes unannounced, right? Change of a political regime, and you might find political risk. You're staring your project staring at a very, very problematic scenario. So political risk is real from an infrastructure perspective. Now, in terms of investing into these asset classes, right, once you decide, okay, I want to make an investment into real estate or infrastructure or private equity or hedge funds or any of these alternative asset classes, there comes issues in performance appraisals. Given these asset classes are so unique, each of them is pretty unique. Each of them may have a very high leverage, estimate. They may have derivatives which are used. So how do you appraise their performance? How do you understand, is your asset performing better? What is the risk parameters around it? So there are certain issues in performance appraisal when you are specifically looking at uh, alternative assets. So from a performance appraisal for alternative investments, two types of investments to achieve returns. You could have a passive or you could have an active investment. Key difference: in a passive investment, you are not part of operations on a day-to-day basis. You are more of a financial investor. Like we said, in private equity, you are an active investor, because if you're a private equity player and if you buy into a portfolio company, like let's say you invest into Swiggy, then as a private equity investor, you can ask for a board position. You can ask for a seat for one of your representatives to be part of the board. And if the representative is part of the board, then the representative uh, can obviously participate in company decisions and actively run the business. So that is where a private equity becomes an active investor. Whereas if a private equity can also be a passive investor, where you put a very small investment into the business, right? You have, let's say, only a 1% investment into the business. Classical example: Reliance Jio. In 2020, Reliance Jio raised approximately, I think, if I remember that correctly, somewhere around $8 to $10 billion from private equity entities. And a lot of the private equity players who invested in Reliance Jio took 1%, 1.5% stake in the business. Now, with 1.5% ownership in the business, you are not an active investor. You don't get a board position, obviously, but you are then a passive investor. You are looking at more from a passive investment perspective. So investments could be passive or active. It all depends. Are you participating in the day-to-day operations of the asset, or are you purely a financial investor in that spectrum? A few risks that are present and can be examined on both standalone and portfolio basis. Limited transparency. Yes, these asset classes in general have a bit more issue around transparency. low portfolio level liquidity. You cannot sell an alternative asset investment any random day. All of these assets are generally lower in terms of liquidity, whether it is real estate, infrastructure, private equity, hedge funds, commodities. Most of them may have lower liquidity. If you are especially doing direct investment, if you're doing an indirect investment through ETF or through securities, the liquidity enhances. Very active use of leverage, and we talked about this, that most of these asset classes will require leverage or use of leverage. General strategy and product complexity, and this is something a lot of you will experience, right? You, or when you meet people around you, or when you look at yourself, you may be comfortable discussing equity markets, you may be comfortable talking about stock markets or equity markets. Equity as an asset class is catching up in India. Equity as an asset class, a lot of us read and understand relatively better as compared to what you are reading in alternatives like hedge funds, right? And when we say hedge funds, macro driven hedge funds or relative value hedge funds, because we don't have a practical exposure on running a hedge fund or investing in a hedge fund. So the product complexity increases in some of these categories, right? InvITs, REITs. How many of us have made our investments into InvITs and REITs where we can actually make that investment? It's open for all of us, right? And it's a fairly low ticket investment, but still, have in our portfolio, do we see InvITs or REITs being a part of the portfolio? So there is a product complexity issue when you are looking at alternative investments. General challenge of manager differentiation and diversification. You will have to figure out which manager is better in terms of performance. Mark to market issues for a portfolio with niche specialized products. These products, or some of these products, are not even traded on a regular basis, right? Some of these are unlisted or not traded actively. And if you're not trading actively on any product or any financial instrument, you don't know what is the fair value today, right? So if you bought a property 3 years ago, you don't know what is the fair value of the property today. You are just relying on what the market indications are. But do you have a professional report supporting that fair value? Is difficult, right? Because these are not traded on a regular basis. You cannot do a mark to market. Mark to market means daily you cannot say what is the profit or loss on the security, because these are not traded. But if you have a traded equity security or a stock in your portfolio, for that stock or for that share that you own in your portfolio, you can do an MTM, mark to market, every day, because every day you know whether you are in a profit or a loss. End of the day, you can do an MTM analysis. These are very, very niche, specialized products. A lot of them don't even have an actively traded secondary market, and therefore doing a mark to market is in general difficult. This brings limited redemption availability and portfolio pressures from eventual redemption activities. Redemption means you want to get an exit, you want to sell out and redeem your investment. Redemption options are also limited, right? If you invest in any of these alternative assets, barring obviously, let's say commodities may be very liquid, right? Gold, for example, as a commodity is extremely liquid. It is as good as cash. You can take the gold to the market and you can sell it at whatever the current rate is instantaneously. But barring that, for example, there are a lot of other assets which have limited redemption availability. You don't find a buyer easily for a lot of them, right? If the government tomorrow says we want to, uh, for example, sell off reserves or oil reserves or oil blocks, it will take time to sell off the oil blocks in India, because you will have a process that will go through a bureaucratic process. There will be an expression of interest. There will be a bidding that will happen, and then within that bidding also you will find limited players, right? 2, 3, 4 players who will bid for it, and all this process takes time. So your redemption availability is lower, your liquidity is lower. You cannot instantaneously convert it into cash. The fee drag associated with alternative investment can be non-trivial, right? So fees is generally on the higher end for all alternative investment asset classes. So you should be ready to pay that fee if you are someone who wants to build a portfolio out of alternative assets. How do you measure performance then for a lot of them? In portfolio management, we learn a ratio called as Sharpe ratio. Sharpe ratio is the most basic metric which is used to assess or evaluate an alternative investment, along with one major flaw in the underlying assumption of normally distributed returns. So the point is, Sharpe ratio only works for assets which have a normally distributed return. What do we mean by a normally distributed return? You have a return which is mimicking a bell-shaped curve, normal distribution curve. Sharpe ratio works wonderfully for equity securities. Sharpe ratio works wonderfully for your traditional asset classes. But Sharpe ratio is not an ideal measure to rely from a alternative asset category, because for alternative investments, the returns are not normally distributed. The returns are skewed. Either you will have a very high positive return or you will have a very high negative return. They don't work for those average returns or moderate return given their risk profile. So Sharpe ratio is a measure or is a ratio to calculate the performance of portfolios, but it is not suitable or ideal for alternative investments. With the given set of atypical risks such as leverage, illiquidity, mark-to-market smoothing, poor portfolio transparency, the return profiles tend to be asymmetric and skewed, as I said, making the Sharpe ratio less than ideal performance measure for alternative investment. For return distributions that are not normal and has significant skewness and kurtosis, volatility is not a perfect measure of dispersion, and therefore Sharpe is not the ratio to rely on. However, please remember, Sharpe is the perfect ratio to use when you're doing portfolio management, when you're doing equity securities, when you're doing traditional asset classes. You won't find a ratio better than Sharpe. But for alternatives, we don't rely largely on Sharpe ratio. We rely more on Sortino as a ratio, comparatively more valuable measure of return performance. It is the return relative to downside volatility. So Sharpe is a return related to total standard deviation, right? When you do a Sharpe ratio calculation, you basically say return on my portfolio minus risk-free return divided by total standard deviation. But when you do Sortino ratio, you say return on my portfolio minus the expected return that I wanted on the portfolio, or you can say my expected return on the portfolio divided by the downside deviation only. What is my downside deviation? I'm not going to look at my total standard deviation, which will include positive and negative data points both. I'm only going to look at the downside deviation, which is possible. So downside deviation or the downside risk is basically a potential loss from investment. So we are only going to use the downside risk deviation here, possibility of losing money. And based on that, what is this ratio turning out to be? So the numerator for Sharpe and Sortino remains the same. There's no change in the numerator. It's return on portfolio minus the risk-free rate, but it is only divided by negative return standard deviation. So Sortino is generally preferred when you're doing alternative investments rather than using a Sharpe, which takes into consideration the total standard deviation from an investment. Frenner is also covered when we do portfolio management. When we study portfolio management, Frenner ratio is also covered there. Formula wise, very similar. Numerator for all the three is the same. Return on portfolio minus risk-free rate, whether you're looking Sharpe, Sortino, or Frenner. Denominator for Frenner is beta. You only look at systematic risk. So when we say Frenner ratio, it is a measure of excess average return of investment relative to its beta. And beta is based on the benchmark such as a broad equity market index, Nifty or S&P 500 or whichever index you are tracking. Alternative assets having low beta to traditional assets are considered to be more valuable. Lower the beta of the alternative asset, higher would be the Frenner ratio, all else remaining equal. Obviously, beta is the denominator of the formula, so higher the ratios. The limitation of Frenner is that its measurement is based on historical beta that may change in the future. Now, beta has a classical problem. You've learned beta, right? You've covered beta in any other subject? You have had an extensive discussion on beta on any other subject, portfolio or equity. I don't know whether quant covers beta or not, but you've covered beta somewhere. Measure of systematic risk. No. Okay. I don't know whether you have covered beta or not in other subjects. Has portfolio been covered for you or not? But remember, beta has a classical issue. Beta is something which is used daily, right? When we work in finance, my team is going to use beta on a regular basis, on a daily basis for that matter. That said, beta has a problem. The problem with beta is backward looking. It is always based on historical data. So beta cannot predict what is going to happen in future. Beta doesn't even understand what has happened yesterday, because if you are calculating beta with a 3-year historical data, yesterday is only one data point out of the last 3 years, and that one data point is not going to change your number drastically. It has a negligible impact on your beta. So for the last 3 years, nothing changed in your company. Your company was an exceptionally good company, but yesterday things have changed entirely. Yesterday a fraud was detected in the business. Beta does not capture that. Beta fails to capture that increase in risk, because that one day data point has no impact largely on the beta calculations. And which is why I say beta has a problem. It is based on historical data, and that problem percolates into trainer ratio also. So trainer ratio therefore gets a bit problematic if your beta is not reliable. The fourth on this category is the Karmer ratio, or the Karmer ratio. It's a comparison of average annual compounded return to this maximum drawdown risk, which is calculated using the prior 3 years of performance, which adjust over time. One of its variation is the MAR ratio, which uses full investment history and average breakdown. So, hand on heart, which ratio will typically be used when you are doing alternative investments? It all depends on the preference. Like for example, the MAR ratio, which is the managed accounts report, or it gets its name from the managed account report newsletter, is less used as compared to Sortino. It's available in the market. No one stops you from using an MAR ratio. But again, the applicability, or what people will typically like to see, the preference is still using a Sortino ratio, which is a mainline ratio, rather than using an MAR or a Karmer ratio. So the ratios are available. All ratios have some advantages, disadvantages. You can pick one which works good for you, right? So that is interesting from a performance appraisal perspective. But what something that you would like to remember from an exam angle, Sortino definitely on your list, because Sortino is something which is tested frequently on the exam. Sharp obviously gets tested, but Sharp is more from a portfolio perspective. Trainer gets tested in the portfolio theories. In alternative, if you want to remember two, I will say Sortino and Karmer ratio. Not from a calculation perspective, there are no calculations which are applicable at present, but this is more from the perspective of theoretical concepts which can be tested in the exam, right? So from that perspective, please try and remember Sortino and the Karmer ratio. Calculating fees and returns. Now, we did have a fair share of discussion yesterday in terms of the fees and the returns or the risks associated with this. Let's quickly do a bit more analysis on those parameters. Levels of risk vary between private markets versus public markets, right? So private markets value securities, value assets in a very different way versus what the public markets do. And I think one of the best examples that we have covered over the last 2-3 years is what happened with Paytm. Paytm, which was valued at several billion dollars in the private market, as soon as you hit the public market tells you, we don't agree on what the private market does. We have a very different way of valuing securities. An IPO which was 2,100 rupees is all the way to 300 rupees in terms of stock price. 90% almost wealth destroyed for investors. So That is where we say private markets can value the startup at whatever number they want, right? That is their choice. Public markets have a much larger investor base, investor fraternity, knowledgeable investors, retail investors, arbitragers, speculators, and the public markets tell you what your true valuation can be. Private markets, you can set the value wherever you want. So there's a very different way of valuing securities in private versus public market, and therefore the risk also varies in the private and the public markets. Returns are not symmetric always. You could have asymmetric risk and return, which means you could have very high risk, very high returns, very low risk, very low returns. It's not necessarily always a balance. Alternative assets also have a limited transparency related despite detailed due diligence. We have been talking about that issue since we started alternatives, that they have a limited transparency as a disadvantage and they are illiquid to that extent. Additional risk while trading in derivatives include operational risk, financial risk, and the counterparty risk. So you could have an operational risk trading into derivatives, financial risk, which is basically loss of capital, and counterparty risk, especially if you're dealing in OTC products, over the counter products, such as swaps or forwards. In swaps and forwards, there is a possibility of a counterparty risk where the counterparty does not make necessary payments on time or defaults. For futures and options, there is no such counterparty risk because there is a clearing and settlement process which it goes through. The mean and standard deviation are not reliable as return distributions are not normal. So calculating an average or calculating a standard deviation is not a reliable metric as return distributions are not normal under alternative investments. Risk measures such as value at risk or the Sortino ratio should be used rather than the Sharpe ratio as we have just discussed. Stress testing and scenario analysis are other useful tools under alternative. For that matter, stress testing and scenario analysis are useful in finance everywhere, right? So in general, whenever you do an analysis, everyone will tell you do some sensitivity analysis, do some scenario analysis, give me a stress test. What happens if the GDP falls by 1 percentage point? What happens to my portfolio? And that is a worst case that I'm trying to bake in. What happens if the GDP increases by a percentage point to my portfolio? The performance depends a lot on the management's expertise and execution. Hedge funds and private equity funds therefore do not face stringent regulations or are less transparent. There is no universal regulator or there is no geography specific regulator. So private equity funds do not have to follow a lot of guidelines, unlike mutual funds who will have a AMFI sitting on top of it or who will have a market regulator like SEBI talking to them. Hedge funds or private equity funds may not have a lot of regulations. Performance fee therefore ensures alignment between interest of investors and managers. Because managers are incentivized, the general partners are incentivized by way of a performance fee. They tend to work in the interest of investors. They would like to ensure that investors also earn returns, because if investors earn return, the managers will be paid incentive fees or performance fees, and therefore it aligns their interest on a one-on-one basis. Example in terms of how the fee structure could pan out. A private equity fund invests $20 million in a new shipping venture and $25 million in a new port business, where the shipping business generates profit of 14 when the company is acquired by a larger competitor. But the port business turns out to be a flop when its state licensing is eventually denied and it generates a $15 million of loss. So in one business, $14 million of profit. In another business, $15 million of loss. Both the businesses were portfolio companies for the private equity fund. If the manager carried interest incentive fees 20% of the profits, what would this incentive be with a European style waterfall whole of fund approach? And what would it be if the incentive is paid on an American style waterfall deal by deal basis? So if you look at a European style, it's a whole of fund, which means we'll do a total profit. In whole of fund, you will say we lost $15 million on one business, we gained $14 million on another business, which means net, we lost $1 million. So with the European style approach, you are not getting any incentive fees because you have lost $1 million on whole of the fund approach. But on an American style, you're paid on a deal by deal basis. So in places where you have made profits, like for $14 million of profit, 20% will translate to $2.8 million of fee on the shipping business. That is where you get $2.8 million. But on the business where you have lost money, you don't get any incentive fees. So the investor lost $1 million. But apart from that $1 million which the investor lost, the investor also lost $2.8 million because he had to pay a fees on another investment. So for the investor, the ultimate loss is $3.8 million net of fees. So it all depends between the negotiations between the GP and the LP, general partner and the limited partner. Would they like to go for a European waterfall, or would they like to go for a American waterfall, deal by deal basis, or a whole of fund approach basis? Because that will change the numbers. There could be custom fee arrangements also. Fee based on liquidity terms and asset size. Like we had a performance fee, like we had a management fee, you could have a fee based on liquidity terms and asset size. This fee arrangement between different investors and hedge fund managers vary differently. While a few hedge funds may charge rates depending on liquidity terms, which means if you agree for a longer time frame to invest, we will charge you lower fees. On the other hand, hedge fund managers may choose to discount their fees for large investors or for placement agents who introduced these investors. You can have a fee which is based on the size of investment, right? If you're investing $100 million, the fees is lower. But if you're investing $1 million, the fees is higher. Possible. That is a way to structure the fees. This is based on the size of the investment. You can change the fee slabs. Different investors, therefore, in the same fund may face different fee structures. Hedge fund managers, therefore, negotiate terms, including fees, notice, and lockup periods, with individual investors via side letters. Remember side letters? There is a primary letter, which is your limited partnership agreement letter. And then you will have side letters for each investor, which are special amendments to a standard offering memorandum's terms and conditions. So in a private equity hedge fund structure, you might find these terms being used on a frequent basis, that where are the side letters, or get the side letters signed. Along with this, there could be founder shares. In order to attract early participation in startup and emerging hedge funds, managers have increasingly offered incentives in the form of founders or founder class shares. These are entitled to lower fee structures and are applicable only on a certain cutoff threshold of assets. So you can offer shares which are similar to what founders own and call them the founder class shares or the founder shares. And this is basically to incentivize early investments, angel investments, or not even angel, perhaps series A investments or series seed investments, because you want people to feel that they are also sort of getting the founder level rights in the business when they are putting their money. Again, these are all optional. These are all based on negotiations. Not every company will offer them. Not every company will have them. Or fees. This is the new fee model introduced as a way to push back against the high hedge fund fees, where some hedge fund managers have started to accept in return for substantive allocations. Managers agree to either charge a 15% management fee or receive a 30% incentive fee above a mutually agreed on annual hurdle, whichever is greater. So you either pay me a higher incentive fee or you compensate me with a very high management fee. Depends what you want. You want this or that. In a way, I should be able to make reasonable amount of profits or money on this arrangement if I am putting my efforts in running a fund or managing a fund and making investments on behalf of a fund as a general partner. So it is all based on negotiation. And again, these are not the only types of fees or clauses. There is also, for example, there is a finder fee. A finder fee means if a general partner is able to find a good portfolio company for investment, he should be rewarded for that additional work that he has done. transaction advisory fee. If a general partner offers transaction services, advisory services, he should be paid a fee for transaction and advisory services also. So there are many more types of fees. The book primarily focuses on management and incentive fees. From an exam perspective, your two biggest point of contention would be management fee and incentive fees. Along with that, obviously, high watermark, hurdle rate, soft hurdle, hard hurdle, you should understand them as a concepts. Perfect. Questions? Anything? All good? Okay, perfect. Actually, we are left with then one last thing on our syllabus, which is digital assets. Now, digital assets is introduced more from the perspective of fintech in CFA, right? So gradually, given the industry is moving towards fintech, you see increasingly more and more players talking about fintech as an offering. CFA has also introduced digital assets as part of this specific module. This covers things such as machine learning, artificial intelligence, blockchain, a lot of the things which we keep reading on an ongoing basis. Now, digital assets created, stored, and exchanged assets. You can have digitally created, you can have digitally stored, or you could have digitally exchanged assets under this digital asset category. It's a relatively new investment class. Please remember that. This has obviously caught up over the last few years, or you can say over the last 3 to 5 years. Wide variety of digital assets under this will include, obviously, top of the mind comes cryptocurrencies. You could have tokens, you could have digital collectibles. Nowadays, a lot of them also go in the form of crypto tokens. You could have NFTs. So all of those will be part of these digital assets. This encompasses, therefore, currencies, tokens, digital collectibles, secured and validated through a distributed ledger technology. The distributed ledger technology is something which a lot of us know by the name of blockchain technology, where you will have advanced encryption techniques which will ensure that the authenticity of your asset is maintained. A digital ledger technology is a decentralized record of all the transactions. Advantage of having a decentralized record is accuracy, transparency, security, rapid ownership transfer, and a peer-to-peer interaction. One of the biggest advantage of having a digital ledger technology is no one person owns it, right? It is something which is distributed, and which is why it is called as distributed ledger technology. Simple language, it's a sort of database. Think about it as a database which is shared between infinite number of entities within a specific network, right? So what is a basic example of a database? I can create, let's say, a Google spreadsheet, right? A Google spreadsheet is as good as a database, right? And I can share that database between all of us. So I can say this is a distributed ledger. In that database, all of us keep making entries. Entries are recorded, stored. You can distribute it across a set of people who you want them to have an access to. So distributed ledger is very similar. You will have it distributed across a set of network participants, and each participant will be able to view a copy of that database. So that copy is a verified record that you're going to see from each participant perspective. It takes away sort of a monopoly that a centralized database has, right? So centralized database will be owned by one person, and he is the only person who's enabled to make changes to that database. In a distributed ledger, everyone can make a change or view the database simultaneously. Disadvantage, data protection concerns. If all of us look at the same data at the same time, there is a protection issue, right? So the idea is some of us can overwrite each other's entries. Potential privacy violations. Yes, with many people getting an access to the database, privacy may be compromised. high computational power requirements. To provide the database to so many users on an ongoing real-time basis, you need very high power computation or requirements. Digital ledger technology, or distributed ledger technology rather, comprises a digital ledger, consensus mechanism, and a network of participants, and they use cryptography to secure data. What is cryptography? It's basically an algorithm which will help you encrypt your data, which will help you secure the data. Therefore, your data is generally not visible, and even if it is accessed, it is not usable by unauthorized persons. Just put it that way. So security and database integrity increases because of the use of cryptography as a technique. Along with cryptography, there are smart contracts. These are again self-executing computer programs based on predetermined terms and conditions. So a smart contract basically is a preset algorithm. You can call it a preset algorithm. It's already in the system and will automatically execute based on certain conditions. Simplest example, if there is an event of default, right? Let's say one of the parties or one of the entities defaults. Then there's a smart contract written that if there is a default, there should be an instantaneous transfer of collateral to the counterparty, right? So if I have given a loan to someone and that person defaults, the smart contract should automatically run and I should get the collateral in my name or in my bank account, thereby protecting or safeguarding me as a lender. So that is a smart contract. Then you'll also hear a lot around blockchain, right? When you obviously read distributed ledger technology or a digital ledger, you hear about blockchain. Blockchain is nothing but a type of digital ledger. A type of digital ledger that records information sequentially within blocks linked together using cryptographic techniques. So it's block by block piece of information and linked together over a period of time. So this is typically the blockchain technology. It's therefore called a block and a chain. You have data or transactions recorded and then sequentially linked to a chained mechanism, and that chain mechanism is primarily your cryptograph. Now, in digital assets, there is also a concept called as consensus protocol. This determines how blocks are added to the blockchain. So blockchains are nothing but, and when we say digital assets, I understand a lot of you come from non-science or non-computer backgrounds. A lot of you come from commerce backgrounds here. So this in a way looks like a tangent to what you have been studying over the last decade or so. But this is where I think a lot of finance is moving now to fintech, and fintech being such an integral part of the field of finance, software is taking priority, or is getting increasingly more talked about in the field of finance. So when we say blockchains, these are nothing but software protocols or software programs which will ensure that you create blocks and you connect them using cryptography. How this chain will be created is determined by the consensus protocol. So I know every transaction will be recorded in a block. Then I know block has to be connected or chained together. This mechanism of how the chain will be created is called as a consensus protocol. Basically, it is a set of rules which will govern how blocks can join the chain and become a blockchain for that matter. The idea of designing a consensus protocol is largely to ensure no malicious manipulations are done or malified intentions are taken care of. Security, integrity of the data is maintained. The consensus protocol therefore works on two broad set of protocols. One is proof of work protocol, POW. Miners will use computers to solve complex cryptographic problems to verify the transactions. And then proof of stake, where network participants will pledge collateral to guarantee the validity of a block. So these two protocols combiningly create your consensus protocol. So when we say proof of work protocol, miners, and therefore you would have heard about, blockchain miners or cryptocurrency miners, they have to consume a lot of electricity and power with powerful computer machines with significant amount of energy requirements, right, to solve these complex algorithmic problems. In this, what can happen when you are creating a blockchain? One standard protocol that everyone follows under the consensus protocol, every participant on the network agrees to one basic concept, that the longest chain of block is the only truthful representation that you are going to find of all previous transactions. So this helps put more security, more integrity into cryptocurrencies or everything which is running on a concept of blockchain. Now, within distributed ledger technology, you also have two types of networks, a permissionless and a permissioned network. So your distributed ledger technology can take the form of either a permissionless network or a permissioned network. A permissionless network, transactions are visible to all the users and anyone can execute a transaction. Example, Bitcoin. Bitcoin is a permissionless network. Any user who wishes therefore to make a transaction can look at what are the transactions existing on the blockchain. The main benefit that we are seeking out of a permissionless network, there is no centralized authority, right? Like, what is cryptocurrency's point of view? They say banking is centralized. In banking, there is a central authority which takes care of the database, and the central authority can confirm or deny my transaction, right? So a bank has a lot of rights to deny or confirm a transaction or validity of transaction because it is centralized in terms of banking. In permissionless network, once a transaction has been added to a blockchain, it cannot be changed. And in a permissionless network, therefore, it becomes important and easy for a lot of people to transact. There is no scope of having a blockchain which is a fraudulent blockchain or does not represent the true data, because multiple people are looking at the same blockchain at the same time. You cannot get up one fine day and say, okay, there is a big fraud that has happened. Unlike banking, where you might keep hearing that, oh, there is a fraud, one of the customers did not pay, and that is only accessible to the bank as an information. A lot of people only come to know when the bank discloses that information in the public domain. Otherwise, investors are at the mercy of a bank to disclose this information. On the other hand, there is a permissioned network. A permissioned network, users are restricted from some network activities and are typically more cost effective than permissionless networks. So in certain cases, you can find permissioned networks where there will be a regulator who will take care of who's allowed or who's not allowed to that network. Remember, both these networks or both these technologies under the distributed ledger technology, both types of network may vary in terms of their access, where membership is limited and unlimited between permissioned and permissionless, may vary on their speed, cost parameters, governance aspect. So there are multiple parameters on which they can vary. So this is a repeat slide, so nothing new here. Types of digital assets. I think most of us are very comfortable on cryptocurrencies. We have heard a lot around cryptocurrencies. So the most famous on top of the list is Bitcoin, right? And anything which is not a Bitcoin is an altcoin. So you can call it a stable coin or a meme coin or other cryptocurrencies. And then nowadays you have your CBDCs, central bank digital currencies. So When we say we are looking at some of these techniques or some of these digital assets, they are the ones which are most commonly used in the market or most commonly seen in the market. Central bank digital currencies are now currencies which are issued by the central bank. So, for example, Reserve Bank of India or Federal Reserve can opt to issue a central bank digital currency. This is nothing but a digital, you can say a digital note or a digital coin, right? End of the day, this is just a tokenized version of your physical or fiat currency. Which, if you have a 500 rupee currency note, tokenized version of that is a centralized bank digital currency. This is an alternate basically to a physical currency, right? So it's not basically a cryptocurrency. You cannot call it a CBDC as a cryptocurrency, but CBDC itself is a type of digital asset, right? You want to club them under the cryptocurrency bucket, you can, but they are more of a digital assets. You can call it central bank's own version of cryptocurrencies. Then besides cryptos, what other digital assets we have? We have tokens, and tokens could be NFTs or ICOs, which are your security tokens, non-fungible tokens, utility tokens, or governance tokens. What are the differences? Let's talk about NFTs, non-fungible tokens. This is basically a digital asset which certifies authenticity of something, right? So, for example, in sports, now you have a lot of NFTs. You can own an NFT which provides you the certificate of authenticity of a specific sporting moment. These are uniquely stamped assets and can represent digital assets in a virtual world, basically. So you're looking at NFTs which can represent iconic moments, sporting moments in a virtual environment. Security tokens, on the other hand, ownership rights. And these are ownership rights associated with public securities, right? So you can have, let's say, land rights, right? So if you want, for example, land, today, land and the chain in which the land has been transacted, right? The land has been transacting now for more than 100 years. So today, if you want to know who was the owner of this property 100 years ago, and then who was the owner 50 years ago, and who was the owner 10 years ago, and now who is the owner, all of that is now getting digitalized. We are now going to have security tokens for land, where you just have a token. You can input that token on any platform, and as soon as you know the security token, you can get the entire background or history of that specific piece of land. Who was the owner, when does it got transacted, what price it got transacted, and today who is the owner, and what is the price that we are looking at. So all of that is something that can be done using security tokens. Utility tokens, again, these are service providers, or within services, you have to pay for services, network fees. You can use utility tokens for pay for these things. Government is now also looking at governance tokens. These are typically more from a permissionless network perspective, help you govern a permissionless network. It is helping you to offer additional information in terms of how to maintain the integrity of a permissionless network. Please remember, this is only for a permissionless network that we have a governance token. Digital assets versus other asset classes. This is where a lot of people have a fundamental view or a differentiating view in the way they view digital assets. How do you determine the intrinsic value of a digital asset? Because they lack cash flow, they lack any type of fundamental growth. After studying a lot of finance, people like me or people like you will always have this question: if I'm going to buy a cryptocurrency, what is the underlying for a cryptocurrency? If tomorrow anything goes wrong, is there something backing the cryptocurrency? Because if I buy a security like a share, an equity security, I know there is a company which is backing that equity share. There is physical assets. If I buy gold, I know there is gold, physical asset. If I buy a real estate, there is a physical asset. If I buy REIT, the REIT is backed by real estate. But for cryptocurrencies, there is nothing which is underlying it, right? It's just a virtual asset. And therefore, there is a big debate in terms of cash flows and fundamental worth of the digital currency. Is it purely based on the usability and tradability, or is there anything fundamental to these digital assets? That debate is yet out in the market, not yet settled, but that's a debate. Then there are variances in transaction valuations. How do you validate the transactions, right? Because you have logged on to decentralized digital ledgers. How do you validate a specific transaction? In a permissionless or a permission network using your consensus protocol, it impacts the value of that security, right? So there is no standard method to validate the transaction value. That how are you setting the value for a cryptocurrency, right? Because it's still not actively used. It's not as if it's replacing our fiat currencies across the globe, and it's a very active mode of transaction. So how do you value basically, or how do you ascribe value to a digital asset is still a point of debate. It's a distinct medium of exchange, predominantly or for online transactions. Potential cryptocurrency usage restrictions. A lot of central banks still don't approve cryptocurrencies. Like RBI doesn't approve cryptocurrencies or transactions for cryptocurrencies. Some companies have announced that they are going to use cryptocurrencies or accept cryptocurrencies, but again, they have moved or taken a step back on it. Simple example is Tesla. Tesla did announce long back that they will accept cryptos as a mode of transaction or a medium of exchange while buying or while for users buying their cars. But they took a back step on this, which impacted again the validity of the, 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 the currency itself. It does exist. Some people will accept it for online transactions, but that's all within that network. People who are aligning with the thought process on digital assets. Divergent regulations, absolutely. All central banks across the globe have a very different opinion on digital assets or cryptocurrencies. There are no standard guidelines at present. There are unregulated exchanges, and the taxation regime is also very, very different across the globe. For example, India basically taxes them at 30%, and then whatever you make as a capital gain is also taxed. And we are trying to just uh, kill the industry. I think at best that is the crude word that I may want to use, because RBI is not comfortable with cryptocurrencies, and for good reasons, because it could be used because in cryptos you are giving the authority outside RBI's realm, and then it could be used for illegal activities like money laundering or terrorism funding, right? So RBI is okay not introducing them or not accepting them in the Indian markets. Trading platforms, India has seen some trading platforms, like you have seen some exchanges which allow you to do cryptocurrency trading, and a lot of people are actually doing it actively. Even small investors are participating in cryptocurrencies as an asset class. There are centralized exchanges which are privately owned, provide transparent pricing and volume data. And then these are exchanges which are most widely used types of cryptocurrency exchange: direct electronic trading on private servers. And then there are decentralized exchanges which enforce blockchain principles without central authority, operates on a distributed framework. So from an exchange perspective, uh, it has to be understood what type of exchange are you going to use when you're trying to transact in these. Some of these exchanges have actually started with all types of zeal, but some of them have actually died over a period of time because the interest in cryptocurrencies keeps fluctuating. It all depends on the price of the cryptocurrency. If Bitcoin touches $100,000, the 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 I think the zeal of participating in a cryptocurrency environment is a bit more, and you will see a lot of people then jumping on the bandwagon. But with the fall in cryptocurrency prices, a lot of people may just walk away from cryptocurrency platform and exchanges per se. Direct investments, You can record and validate transactions on the blockchain if you're directly investing into cryptocurrencies. Purchase tokens, trade NFTs, or invest in ICOs. Risk of fraud obviously is there. It's not as if these are foolproof in terms of their approach. There is a possibility. Risk of fraud, fraudulent ICOs, market manipulation, theft, and wallet-based credential breaches is available. Indirect investments, you can go through cryptocurrency coin trust, which offer shares in trust holding large cryptocurrency amounts. Again, a lot of this is not available in Indian market. Please remember, when we are talking about this, back of the mind, I think we should always be sure that this is more from a US market perspective, which is now opening up on the possibility of cryptocurrency as a asset class. Future contracts or exchange traded products, stocks, and hedge funds. You can participate through either of these things. We don't have any stock for that matter, which allows you to participate in cryptocurrency once again. So we don't have that asset classes. So it's at times difficult to relate to a lot of these things, but we can fairly assume they're very similar to what you have for other asset classes. So like you will have a gold ETF, you have a gold based stock to trade, you have a hedge fund. They are just exclusively dealing into cryptocurrencies. The strategies may remain the same, the underlying asset class changes. And that is the best way to perhaps get over with cryptocurrency related concepts. Gradually, as I said, we are now heading towards digitalization of non-digital assets. And in this category, we are saying we are going to have asset-backed tokens, like utility tokens, which will represent ownership of physical or financial assets digitally. So if you have lands, that land block can be represented, or now ownership for a land can be showcased digitally, right? It's a physical asset that you have, but you can have a digitally as backed token or a utility token to represent the ownership in land. These are typically secured by the underlying asset. Yes, you can trade that token. Other than trading the land, you can trade the token. If someone wants to just speculate on a piece of land, they can buy the token and they can sell the token at a higher value when the land price appreciates. Potentially enhance liquidity of high value assets, right? So for high value assets like land, real estate, infrastructure, using tokens may be a way to perhaps transact and operate through it. We have done that for real estate using REITs. We have done that for a lot of infrastructure assets using InvITs. Possibly the next best option is land, because that is one which is an asset class transacted on very heavy volumes and heavy prices. It enables immutable ownership records also. You will be able to get ownership records for as long as you can go back in history for all of these assets, which is at present really difficult. In Indian markets, if you want land records, it is one hell of a thing. You have to go and get connect to the municipal authorities, the local tehsils, and then you have to get the khasra number, and there are a lot of things that go into a land ownership. And again, you are not sure whether that is clean title or whether that's a disputed title. So all of that can be resolved for land ownership once you have asset-backed tokens. These can be categorized as securities and digital securities, which can be easily traded on any secondary platform. Makes life easier for a lot of investors. Perfect. So that is all that we had in terms of theoretical aspects of alternative investments. What we'll do, we'll take a short break, and then we have few questions that need to be finished as part of your regular reading material. We'll pick up those questions and post the questions. We'll wrap up the sessions. We'll be happy to take any questions that you may have on alternative post this break, and then we'll head towards the end of the session. So take a break. 10:28 my clock. 15-minute break, good enough. I think 10:45 is when we pick up this session, and we start off with questions. And I'll be happy to take any questions that you have around the content or the curriculum. And we'll close the day for alternative investments. So take a break and we'll assemble post the break to finish off the session. Okay, perfect. Welcome back. So we have a few questions to cater to as a quick, part of what we have covered, and we'll just walk through the questions. And happy to take any queries that you have on the questions. But before that, we begin. Any questions from your end on the content on alternative investments? I forgot to put this up front, but I think you can stick to Kaplan Schweizer. If you're using that as a content to read alternatives, it should be more than sufficient for you to cover alternative from an exam perspective. Any other content? If you're obviously using the CFA curriculum, that is the best content available to read. But obviously, the volume of the content is significantly higher if you're using the CFA content. So pick one that works for you depending on your attempt. When are you signing it up for August or for the November attempt? Accordingly, I think you will have time in hand to use one of the two. For alternative, I think Schweizer should be more than sufficient. And if you're using any other publisher, I think that should also hold valid. I have not read, for example, Willy as a publisher, but Willy does publish CFA content nowadays. So if you're using that, I think that should be okay. Chili, perfect. Let's roll it forward on the questions which are lined up for this specific reading. So to begin with, the first question, which is about mezzanine financing. Mezzanine financing enables a company to fund its research and development expenditure of new ideas, source financing till the IPO is completed, or commence commercial production of a new product. We have talked this, I think, previously yesterday in our session, that mezzanine financing is a bridge financing basically. And this bridge financing is largely done in order to get your company to the IPO stage, right? So mezzanine financing, for that matter, is largely for IPO related offerings. So this is where we say option B should be the right option. Before mezzanine financing, what you get as a late stage financing is used to commence commercial productions. The third stage or fourth stage of financing is for commercial production, and the seed financing, the first stage financing or the second stage financing, is for your research and development expenditures of new idea. That is your seed financing per se. So the right option here should be B, source financing till IPO is completed. One of the hedge funds bias is that the performance of failed funds is not included in the index. This is known as self-selection bias, backfilling bias, or survivorship bias. Now, remember this, failed funds means you are not including negative data points, right? You're not including negative data points in your calculations. And if you're not including negative data points in your calculation, you are only including survivors in your calculation, people who have delivered positive returns in your calculations. This is a classical example of a survivorship bias. If you exclude failed funds which have not performed well from your calculations, then you are only relying on funds which have performed well, good. They are only positive data points, and all these positive data points will give you a survivorship bias. A survivorship bias is an upward bias, or it's a positive bias always. It gives you numbers which are overstated. So your returns, for example, for hedge fund, will be overstated returns. You may say that hedge fund has delivered 32% return, but in reality, their returns may be well below 32 because they're not taking any negative data points in their calculations. So this is primarily on account of survivorship bias, and that is why your right answer should be survivorship bias. What do you mean by selection or self-selection bias here? Self-selection bias occurs when the person who's calculating returns, for example, voluntarily chooses to participate in a study or program group rather than being randomly selected into one, right? So in a self-selection bias, you are not being randomly selected, or you're not randomly selecting securities. Ideally, you should randomly select securities and then randomly select funds and then see what the returns are. But in self-selection bias, you are selecting those funds which you believe have given better returns and therefore creating a bias. Then it is not a random process, right? If I have to do an average and if I know that my 10 funds have done best, or I know more or less they have done better performance. And if I select them, then that is not a random selection. That is a self-selection bias. I'm creating a bias in my return calculation using a self-selection bias. What is a backfilling bias? A backfilling bias is you have done a return calculation with 10 funds today, and after 1 year you say, okay, one fund has performed good, so I'm going to change my data, which was earlier only 10 funds, to 11 funds. I'm going to fill my data backwards because now that data point is looking good. So I'm going to change my data point itself. I'm going to go back in time, update my study to include a good looking data point, and then restate my conclusions. So that is a backfilling bias. You're going back and filling up the data again to create a bias in the data. But for this question, the right answer has to be survivorship bias. The third one on the list, alternative investments are characterized by only or characterized by long only positions in liquid assets, extensive use of leverage, or transparent and reliable risk return data. So we have talked very clearly that transparency is an issue in alternative investments. They are not as transparent as equity in instruments or debt instruments. Again, they don't only look at long positions. They can be long, short, market neutral. They take all types of position. But yes, we agree they use a lot of leverage. So the right option here should be extensive use of leverage. They are characterized by extensive use of leverage. Then comes question number 4. So contango commodity market. We actually didn't had anything around contango in the notes, but contango is generally covered under derivatives. Now in a contango, and there are two things. There is a contango and there is a backwardation. There are two concepts. There is a contango concept and there is a backwardation concept. In a contango commodity market, unchanged spot price results in roll yield that will generally be negative. So I'll just skip the question per se because this is more of a derivative concept. This is generally covered in derivative in detail, contango, backwardation, roll yield, all as a concept. I don't know how that question has been placed on this list, but for now, I think skip the question. Nothing for you to worry about. You should carry this from your derivative books if asked. Fifth question, Ms. Lena is looking for an exposure in alternative investment with an intent to get regular stream of income. Which of the following asset classes most likely serves her purpose? Commodities, timberland, or collectibles? Where do you think there will be a regular stream of income or regular source of income? What do you think? Where do you think there will be a regular source of income? Commodities don't offer you a regular source of income that we have talked about previously. Commodities do not offer something called as, dividend or interest. Collectibles again are illiquid. Collectibles, stamp collection, for example, does not offer you regular income. What can offer you regular income is a timberland, right? If you have a timberland, you can obviously sell timber on an ongoing basis, and that can offer you returns on a regular basis. So the correct answer should be timberland here. The limitation in which the disclosure of past performance of all the fund managed west with the fund manager is termed as backfilling, survivorship, or self-selection bias. We just talked about this, that if the fund manager decides that which funds managed should be included in the disclosure of past performance, that is self-selection bias. The fund manager is then biased towards selecting funds which should be included in your calculation. So that is a self-selection bias. Question number 7, which of the following is least likely correct? Survivorship bias leads to the index being calculated on the basis of surviving funds only and may ignore the funds that are closed, and hence risk is overstated. The investments made by hedge funds may not be traded actively resulting in the managers using stale prices and hence reporting stability in the fund's performance, thus understating the variance. Managers may cherry pick and report only those funds that have strong performance, leading to self-selection bias. Which of the following is least likely correct? In exam, please focus. Are they asking least likely or are they asking most likely? A lot of people do a basic mistake on that end. So what do you think should be the answer? A, B, or C? It's a fairly simple one. The way to look at this is option number A, or option A basically. The point is survivorship bias leads to index being calculated on the basis of surviving funds only. Agree. That is correct. And may ignore the funds that are closed, which is also correct. And hence the risk is overstated. Risk is actually understated because you are showing higher returns. You're showing higher returns, which means you're showing there is lower risk. We were able to deliver better returns. Your standard deviation will only include positive data points. It does not include negative data points, and you are understating the risk. In reality, the risk, or you are overstating the risk. In reality, the risk stated or risk based on such data points will be understated, not overstated. Rest of the two are absolutely correct. So the least likely correct is option A here. You are overstating versus the risk should have been understated here. Perfect. So that is all we have for today on alternative investments. If you have any questions, happy to take the questions. If not, I think that wraps up alternative for us. Fairly short reading. In general, this is something which can be covered for you. Sit 1 day or 2 days perhaps and finish off alternative. The key point is focus on maybe the digital asset related reading because that's relatively new to a lot of you who don't come from computer science backgrounds. Apart from that, I think this should be manageable, mostly theoretical. There is no mathematical construct per se. Questions? In case you have questions, there is a possibility you get questions once you start reading this, right? Feel free to reach out. I should be available on the following number. If you have any questions, I will be available here to address your queries as well offline on a one-on-one basis. Anything before we close it out for the day if you don't have any questions? Okay, perfect. If you have no questions, we'll call it off for today. Enjoy your day. Have a good day. And please reach out if you have any questions. Thank you.